On the morning of June 18, 2020, the auditors at Ernst & Young announced that €1.9 billion, money that Wirecard had listed on its own balance sheet, money that was supposed to be sitting in trust accounts in the Philippines, did not exist. The banks said they had never held it. The accounts said they had never existed. And in that moment, the ninth largest company in Germany by market capitalization simply ceased to make sense. 4 days later, Wirecard filed for insolvency, €24,000 million in shareholder value gone, and the question that followed was not just how, it was how long, because the money had never been there, and almost nobody had looked. To understand Wirecard, you have to go back to Munich in 1999, to a payments processing startup operating in one of the internet era's least glamorous corners, online gambling and adult entertainment. These were industries that major banks refused to touch, which meant anyone trying to take a credit card payment for them needed a specialist. Wirecard was that specialist. It processed the transactions that respectable institutions preferred not to see, and it made money quietly, reliably, at scale. The founder was Markus Braun, an Austrian computer scientist who took control of the company in 2002. Braun was an unusual CEO. He dressed almost exclusively in black turtlenecks, a sartorial choice that felt less like a Jobs imitation and more like a considered persona, a man who wanted to be read as a visionary. Under his leadership, Wirecard pivoted away from its murky origins, or at least claimed to, repositioning itself as a full-spectrum digital payments platform for the emerging global e-commerce economy. The pitch was seductive, a European technology company that could compete with Visa, with PayPal, with the giants of Silicon Valley. A homegrown champion for the German tech sector, which had never quite produced one. The growth story was compelling. Wirecard expanded into Asia, acquired payment companies across the developing world, and reported revenue figures that climbed year after year. By 2018, it had joined the DAX 30, the index of Germany's 30 largest listed companies. It was the first fintech company to do so, displacing Commerzbank, a 150-year-old institution. The symbolism was intoxicating. The future had arrived, and it was wearing a black turtleneck and processing payments from a campus in Aschheim. At its peak, Wirecard's market capitalization reached approximately €24 billion. Analysts loved it. Fund managers owned it. The German government treated it as a point of national pride. And through all of it, buried in quarterly reports and audited accounts, the lie was growing. The turning point was not a single meeting. It was a structural decision made early and compounded for years. Wirecard chose to grow through acquisitions in markets where due diligence was nearly impossible to conduct from Munich. India, Southeast Asia, the Middle East. These were jurisdictions with fragmented regulatory oversight, local banking relationships that were difficult to verify, and transaction volumes that could be reported without independent confirmation. For a legitimate company, this would have been merely complicated. For a company engaged in fraud, it was the architecture of concealment. The mechanism, as investigators would later piece together, involved a network of third-party payment processors, companies in Dubai, in Singapore, in the Philippines, that Wirecard claimed were processing payments on its behalf in markets where it lacked direct banking licenses. These partners, Wirecard said, were holding large escrow balances on the company's behalf. That was the explanation for billions of euros sitting in overseas accounts rather than on European balance sheets. The explanation was plausible. It was also, in substantial part, fabricated. What made it work was not cleverness alone. It was institutional deference. Wirecard operated in a regulatory gray zone between a technology company and a bank. Germany's financial regulator, BaFin, which had authority over banks, was uncertain how much of its oversight extended to a payments processor. When questions arose, responsibility shifted. When auditors asked for confirmation of the overseas balances, Wirecard produced documents. The documents looked real. And for years, nobody flew to Manila to check. The first public warnings came not from regulators, but from short sellers and journalists. In 2015 and again in 2016, reports circulated suggesting that Wirecard's Asian operations were generating suspiciously smooth revenues from apparently thin operations on the ground. The Financial Times, specifically a reporter named Dan McCrum, began publishing a series of investigations that raised increasingly specific concerns about the company's accounting. McCrum found anomalies in subsidiary filings, mismatches between reported revenues and the apparent scale of actual business activity, and partnerships that appeared to exist largely on paper. Wirecard's response was swift, coordinated, and devastating in its effectiveness. The company accused the Financial Times of market manipulation, filed legal complaints, and hired private intelligence firms that would later be linked to former intelligence operatives, to surveil journalists and gather information on short sellers. The campaign worked. BaFin launched an investigation, not into Wirecard, but into the short sellers who had bet against its stock. The journalists at the Financial Times were placed under criminal investigation in Germany. For a period, publishing negative stories about Wirecard carried legal risk, and the stock climbed. This is the detail that makes the Wirecard story something more than a corporate fraud. It is a story about how power, financial, legal, political, can be weaponized to silence truth. McCrum received threats. His sources faced legal jeopardy. And while German prosecutors and regulators focused their attention on the people who had correctly identified the fraud, the people running the fraud continued running it, continued raising money, continued reporting phantom revenues, continued submitting fabricated bank statements to their own auditors. Ernst & Young had audited Wirecard for a decade. During that time, they signed off on accounts that included billions in cash that did not exist, revenues from partnerships that generated no verifiable economic activity, and a business model that in its Asian division appeared to operate primarily as a ledger entry. The auditors, in their defense, requested confirmation of the overseas balances. They received confirmation. What they did not do, what nobody did for years, was obtain that confirmation directly from the correspondent banks, bypassing Wirecard's own representatives. When KPMG was finally brought in to conduct a special audit in 2020, that is exactly what they did. The confirmations did not come back. By April 2020, KPMG's report was damning without being conclusive. It could not verify large portions of Wirecard's reported revenues. The company claimed the data it needed was being withheld by third parties. The stock fell but did not collapse. There were still believers. There were still analysts issuing buy recommendations. The institutional faith in Wirecard had become, by this point, something close to psychological necessity. Too many funds owned it. Too many banks had lent against it. Too many reputations were staked on its legitimacy for the fraud to be admitted cleanly. The end came in June 2020. Wirecard's auditors at Ernst & Young refused to sign off on the 2019 annual accounts without confirmation of the 1.9 billion euros sitting in Philippine trust accounts. On June 18, they announced they could not obtain that confirmation. On June 19, Wirecard disclosed a 1.9 billion euro hole in its balance sheet and acknowledged the money might not exist. On June 22, Marcus Braun resigned and was arrested within days. On June 25, Wirecard filed for insolvency, the largest such filing in German corporate history. The chief operating officer, Jan Marsalek, a figure who had long been suspected by investigators of being the operational architect of the fraud, had already fled. He had been granted leave by the supervisory board and boarded a plane. He has not been found. As of this writing, he remains a fugitive, believed by some investigators to have connections to Russian intelligence, living somewhere outside the reach of European authorities. The Philippines said he had never entered the country on the dates Wirecard's records suggested. The accounts he was supposed to have personally overseen did not exist. 15,000 employees woke up on the morning of June 25, 2020 to find their employer insolvent. Many had been paid partly in company stock. Investors across Germany, the United Kingdom, and Asia absorbed losses totaling tens of billions of euros. Pension funds, retail investors, sovereign wealth funds. The German parliament convened a special investigative committee. BaFin's president faced calls to resign. Several did resign. A regulator that had spent years investigating journalists and short sellers now had to explain why it had never once looked carefully at a company that turned out to be, in significant part, a fiction. What remains of Wirecard is not nothing. The payment processing technology was real. Some of the infrastructure worked. A British subsidiary was sold. Other assets were acquired by competitors. But the company itself, the DAX-listed champion, the fintech giant, the story Germans told themselves about European technological competitiveness, that was gone. And in its place, a question that will outlast the fraud by decades: how does something like this happen in plain sight? Answer is not that everyone failed. It is that the system was designed, whether intentionally or through accumulated institutional habit, to make certain questions difficult to ask. Wirecard existed in a regulatory gap. It was too technological to be treated like a bank, too financial to be treated like a tech company. BaFin had the authority to regulate it, but was uncertain of the scope. The Frankfurt Stock Exchange had listed it, but relied on auditors for financial verification. The auditors relied on documents provided or brokered by the company itself. Nobody owned the question entirely. And in that distributed responsibility, accountability evaporated. Short sellers, functioning as the only truly adversarial scrutiny in the entire ecosystem, were treated as the threat. A journalist doing exactly what journalism is supposed to do, investigating a powerful institution with public money and public trust, was investigated as a criminal. The inversion is almost total. The people who were right were prosecuted. The people who were lying were protected. And the protection was not sinister conspiracy so much as something more mundane and more dangerous: institutional incentive. Everyone with authority over Wirecard had a reason to believe it was legitimate, and a reason to avoid the consequences of discovering it was not. That is the lesson Wirecard leaves behind, and it is not comfortable. Every organization has a version of this trap, the version where the numbers are too good to question, where the explanation is just plausible enough, where the person raising concerns is framed as the problem, where the cost of looking is deemed higher than the cost of not looking, until it isn't, until the auditors call the bank directly, until the 1.9 billion is simply not there. What remains of Wirecard today is a cautionary ghost. The brand is gone. The index slot it occupied was quietly filled. Markus Braun sat in a German courtroom awaiting trial, facing charges of fraud and market manipulation. Jan Marsalek remains missing. Dan McCrum, the journalist who was investigated for telling the truth, eventually shared in a Team Pulitzer Prize. There is something worth sitting with in that final image. The largest corporate fraud in German history was solved not by a regulator, not by an auditor, not by a bank, not by a government. It was solved by a reporter who kept asking the same question for 5 years while the entire system told him to stop. The money was never there, and almost everybody with the power to check had decided, for reasons that made sense at the time, not to.